How to write a financial statement. Financial statements are the formal record of a company's financial activity. The main components of a financial statement are the balance sheet, the income statement, and the statement of cash flows. The balance sheet shows the assets, liabilities, and the shareholders' equity at a specific point in time. The income sheet, on the other hand, shows the revenues, expenses, and income or loss for specific period of time, usually a month, quarter, or year. The statement of cash flows shows the cash balance at the beginning of a period, the inflows and outflows of cash during a specific period, and the ending cash balance. For public companies, what goes on these sheets is regulated by the Securities Exchange Commission in compliance with Generally Accepted Accounting Principles (GAAP) established by the Financial Accounting Standards Board (FASB). You should hire a professional to make sure you are compliant with those standards if you are unfamiliar with them. Building a balance sheet. Understand the basics of the balance sheet. The balance sheet is called so because it shows the company's balance between assets and liabilities. The key underlying basis of the balance sheet is the basic accounting equation, which is total assets equals liabilities plus shareholders' equity. Text total assets equals text liabilities plus text shareholders' equity. Rearranging the equation, you can see that equity is equal to assets minus liabilities. The balance sheet reflects this relationship. All assets and liabilities are listed and added up on the balance sheet, then liabilities are subtracted from assets to arrive at a figure for shareholders' equity. Balance sheets may be constructed using accounting software. Or, you can simply create a spreadsheet or written list with two columns that can be used to total your assets and liabilities by category, too. Determine your assets. Your assets are anything that you own, including the cash you have on hand. Assets usually divided into current assets and fixed assets. Your current assets include the cash you have on hand and what could be liquidated quickly, usually within a year. In this category, you would have things like your accounts receivable, what people owe your company, any securities becoming due with a year such as bonds or savings accounts, and your inventory. It can also include prepayments or deposits you've made ahead of time, such as insurance for the next year. Fixed assets are tangible and known as property, plant, and equipment. These are assets with a useful life in excess of 1 year. There are also intangible assets that may be held on a balance sheet. These include patents, brand recognition, and copyrights, along with other non-physical assets. 4. All of these assets need actual dollar figures in your balance sheet. These can be calculated exactly or estimated based on and in compliance with industry convention. Write all the information up. To write the balance sheet, you need to lay this information out in detail. That is, you need to label each asset along with the dollar amount, divided into current and fixed assets. Add all of your assets up into a total. Determine your liabilities. Your liabilities are what the company owes or has paid to other companies or people, including employees. In other words, it's the company's debt. These assets are also divided into current and long-term categories. Current liabilities include things like what you owe on lines of credit and credit cards, as well as anything owed to other companies for goods and supplies. It also includes the income and wages you've paid out to employees and taxes owed, along with unpaid rent and utilities. 7. Long-term liabilities include long-term loans payable, bonds payable, and other liabilities that will be paid out over a time period longer than 1 year. 8. Make a record of your liabilities. Just like your assets, you need to account for each liability in major categories, such as loans, mortgages, and so on. Also, divide your liabilities on your balance sheet into current and long-term. List liabilities by category and include the value of each category next to its name. Add up all your liabilities to get your total. Subtract your liabilities from your assets. To figure out the shareholders' equity, also called shareholders' equity, you subtract what is owed from what assets you have. A positive amount of equity indicates that the company has financed its operations with its own money or that of investors, rather than relying as strongly on debt. Have a line for your total assets. Below it, have a line for your total liabilities. Show what the shareholders' equity is when you subtract the second from the first. Expand on shareholders' equity. On your sheet, have a section where you show what the shareholders' equity is. This section will include items that represent the shareholders' interests in the company. For example, common stock, preferred stock, capital in excess of par, and retained earnings are all common shareholders' equity categories. When you've listed these categories out, sum them up to arrive at total shareholders' equity. 10. Compare your total to the difference between assets and liabilities from your earlier calculations. If the figures don't match, either you or the accountant that keeps the company's books has made a mistake somewhere along the way. Many balance sheets are organized such that the assets are totaled on the left and liabilities and shareholders' equity are totaled on the right. This provides a more literal representation of the basic accounting equation. 11.